Hey, good morning, everyone. It is Thursday. It's our third day of trading. We had that shortened week because we had the Labor Day holiday. It's nice to have a day off. It'd be nice to have an upward market for a change. We had a very down Tuesday of trading where the NASDAQ was down more than 3%. And yesterday, the NASDAQ was trying to go into the green. It stayed in the green for a while, and then it ended in the red. So we've had 2 days on the NASDAQ in the red, and the NASDAQ's down more than 3.5% in 2 days. That's a very substantial loss of equity in the NASDAQ. Big part of that was NVDA, which lost a massive amount of market cap. I think at this point, NVIDIA lost almost 10% on Tuesday and about a point and a half yesterday. So it's probably up there 11%. Less valuable than they started with at the beginning of the week. So I think that had a big impact on the NASDAQ returns. As we look at the market, it's good to see that Ethereum and BTC are up a little bit. That hasn't been doing very well for me. My crypto portfolio has been down. In August, it was down. It's not doing great this month, but it's good to see it in the green this morning. Oil is up a little bit, not too much. We've had some economic news this morning that I wanted to cover, kind of go over a few data points that I think are important for the day and see what I think is going to happen throughout the day and maybe to close out the week. Hey, Trader Brad, thanks for joining, man. Very, very nice of you to join. Hopefully you're having a nice morning. So the economic news, we had employment reports come out, and when I read them, they look okay. There is one report that concerned people, and that's the ADP employment change. And those are like new postings for jobs. You can see that the number came in far lower than what it was expected. So I think that there's concerns that jobs are being lost. And as you lose jobs, you lose the confidence of the consumer. And the consumer is like 70% of our economy. So if the consumer loses confidence, it has an effect on the economy. If we have a recession, it has an effect on stocks. Just growth stocks especially, they're not as optimistic that, oh yeah, we're going to grow at 50%. No, we're going to have a recession, so we're going to have to slow our growth down. A lot of things will slow down. Having said that, I think that was the bit of bad news, but there was some good news. Initial jobless claims were a little lower than expected. Continuing job claims were a little lower than expected, so that's good. And the 4-week average was a little higher than expected. So that was the news that hit the wires today. Tomorrow we have another report, which is the unemployment report. And this one's clear. This one tells you unemployment. And the Federal Reserve has two mandates. One is to keep inflation down. Their target is 2%. The other is to keep people employed. So they don't want the unemployment rate to be too high. Those are the two things that they're focused on. So if the consensus is for it to come in at 4.2%, and you can see that it's been going up, you see the chart there, it's been going up. And I've been looking at that because if unemployment goes up again, the confidence of the consumer goes down. And that's where just the environment changes for the stock market. I don't think I need to convince anybody that the stock market at times is very emotional and irrational. And if you get it going with, hey, there's a recession coming, it'll be repeated a million times by all the news outlets. And next thing you know, everybody thinks that, we're going to have a massive depression that's going to last 20 years. It seems that way at times that, I'm exaggerating, but it's not far from the truth. It seems with some of the news coverage. So you can see that it's been climbing. So I've been watching that just because, I'm a long-term investor. If there's a recession, am I going to sell my Meta stock? No, I'd probably buy more. I'm probably buy more Alphabet, probably buy more Uber. I'd probably buy more shares of the stocks that I already own. No problem. But I just want to be aware. So I'm not like, oh, completely surprised by it. I'm actually, taking information in and trying to do something with it. So that's what's going on. Tomorrow, we'll see that report. If that report surprises, let's say it came in at 4.5, which would be higher unemployment, which would be a very bad news event. I think we're going to see the market kind of repeat Tuesday. It's going to be ugly. If the report comes in at like 4, which is more optimistic, more positive, the market can really rally, especially since we had such a terrible Tuesday, we could really see a rally. So that number, I'm going to keep an eye on tomorrow. And join me again tomorrow, 9 a.m. Eastern. We'll watch the stock market open. We'll read this report and see what's going on. Another thing that I look at is interest rates. Not because I want to live the most boring lifestyle known to mankind, but because it's really important to keep an eye on it. Interest rates really affect valuations of stocks. If you watch my videos and you watch my analysis, there's a discount rate. And that discount rate really affects how much a company's worth. As interest rates fall, you see small caps rise in value because the discount rate you're using on a small cap is different. It's lower. So as we see interest rates drop, it actually is very good for small caps. It's very good for companies that carry debt because they can refinance that debt and have less interest expense. So I keep an eye on interest rates, and they've been falling, man. This week, they've fallen substantially. Tuesday, they fell substantially. Wednesday, they fell substantially. They're down this morning. So if you're refinancing a house, or you're buying a house, that's good news for you. If a company that has debt, that's good news for them. So that, to me, is good news that interest rates are beginning to go down. There's also a misconception. You know, my lovely wife and I were hanging out last night, and she's like, well, the Federal Reserve is going to move interest rates down, and then interest rates will correct, or will follow the Fed's move. And I said, not exactly. The bond market, this 10-year treasury, this sets mortgage rates, and it's already adjusted to what it expects the Fed's going to do. Market forces move interest rates. The Federal Reserve certainly influences it, but they don't set it. It's not like they set it and then the rest of the economy follows what they're doing. No, the treasury market and how it's priced by investors, buyers and sellers of bonds, they set interest rates. And that's a misconception out there, but it's all cool because I think they kind of align, right? The Federal Reserve is expected to come out and cut interest rates by, I think, 0.5 point, 50 basis points. And I think that'll be the right thing for them to do. But that is, again, not the way interest rates work. It's really a market-driven force, which it should be. All right. So enough of interest rate talk. Let's talk about stocks. Yesterday, some high flyers. We covered on stocks C3.ai, and really surprised that the stock just tanked 20%. I expected it to go down, but I expected it to go down 4%. And boy, did I miss it. I think by the time they awarded, who won, it was down 12 or 13%. And whoever won, congratulations. That was a heck of a pick, man. But now it's down 20%. Holy smokes. I guessed down 4%. I was way outside the zone of being accurate, and I still won $1. Woohoo. So I'm accumulating a pretty good balance. I think I'm up to almost $20 on my stocks balance, which is cool. We'll see how I do today with Broadcom, which is the stock that I really cover. We will review Broadcom on this live stream. I'll share with you my analysis on Broadcom and my history with Broadcom. Other notables that lost a lot of lost a lot of value, and I realized that I wasn't really showing you the screen properly. I apologize, but C3 was down 20%. On a positive note, Applied Digital, look at that. These are like really small caps. Faraday's been really rallying. I think it rallied earlier in the week. This is where these get a lot of attention because they go up so darn fast, right? But it is a pretty risky zone, man. I don't play a whole lot in this zone. I like making, plenty of money every year. And I've got a recipe to do that. I do take chances, but I don't like taking chances on companies that I don't have a lot of information on. A lot of these tiny companies, it feels like a guess altogether to invest in them. But if you figured it out, awesome. Hopefully you make tons of money there. All right. So I've had a couple requests come through, people putting comments on my videos and on Discord. And I'm going to go over some stocks that people wanted to see, and that's where I'm going to begin. If you want me to review a stock that you're interested in, put it in the chat and I will jump on it. If you later on today, you're like, man, here's a stock. I'd like one more opinion on it. I'd like to see somebody else's point of view on it. Shoot me a Discord message or get to me somehow or show up tomorrow or put it on the chat within Stocks. Just go to Stocks. My channel is always out there and just put it out there. Hey, can you review this symbol? And I'll review it tomorrow. If you gave me that symbol over the weekend, I'll review it the next trading day. I'm going to do this live stream every trading day. So if we don't trade that day, I'm probably not going to do it at 9 a.m. Eastern. I might do a live stream, but it wouldn't be focused like we are today on the market. All right. So let's talk about Schlumberger. Schlumberger is a part of the oil complex, and they do a lot of services for the oil complex. Now, my background in oil, my first job out of college, way back when, was to go work for a big oil company. And they offered me, coming out of college, I was an accountant, and they offered me the most money and the best like benefit package and just a lot of good things, man. They had plenty of money. And I learned a lot about the oil business. And I've always kind of kept up with the oil business. I've been a Chevron stockholder for a long time. And I work for an oil company that got acquired by Chevron. And the long and the short of it is, I guess I've always stayed connected because they were the first job out of college. They were super cool to me. So I always wanted to be an investor. And I've gotten to know Schlumberger as well as other companies. Schlumberger doesn't extract, it doesn't own the oil, it doesn't own the reserves, but they have, they help you with creating the wells, kind of the infrastructure for an oil company. So Schlumberger, their customers are Chevron, Exxon, those types of companies, and they provide those services. Now, what affects their revenue is oil prices. And oil prices have not been doing great. And you guys could see my screen there. Let me see if I can make this guy bigger. Yeah, it's bigger. Okay. And right now we're at $69.79. We've been, as recently as high as $86, $87. Oil companies are profitable above $60 per barrel. But if you get up to $100 a barrel, they're really profitable. Man, they just start printing money. If you look at the valuations of Exxon or Chevron, when you have oil above $100 a share, they become really, really valuable, and their stock prices show it. In this case here, oil prices are not very high, and the demand for Schlumberger is probably not very high because oil companies are like, well, we're not in a hurry to extract more oil because we can't sell it at a very good price. So they may not be overly optimistic or in a hurry to tap into wells. Schlumberger has been growing their revenues. If we look at the annual rate of growth, and even the quarterly is very good. So that looks really good. So to have growth, to be in the green is very positive. In 2020, I give a lot of industries a complete pass on 2020 because we had the pandemic. And during the pandemic, we didn't need as much oil because people were like stuck at home, not driving their cars. A lot of things kind of came to a halt. So very good there. And as we look at earnings per share, very good growth on profits, good growth on revenue. So the revenue looks really good. Let's look at balance sheet. Make sure Schlumberger doesn't have too much debt. They have $4 billion of cash on the balance sheet. And they have total debt of $13.3 billion. So when you decrement the $4 billion of cash, we're at like 9.3 of net debt. And if we look at EBITDA, 7.8 billion. So they could pay their debt off in like a year and a quarter, a year and a half if they just focused their EBITDA and said, hey, let's pay off debt. They don't have to because they have a good balance sheet, very good balance sheet. So no problems with the balance sheet. Now let's go to my favorite statement of cash flows, because that's what drives the value of companies. So when we look at free cash flow, that's cash from operations minus capital expense. They grew it nicely in the last year. They did kind of go down quite a bit. It looks like they had to invest quite a bit into the business. Now, I like that they're positive. I like seeing an upward trend. And these guys are not showing that to me, but they are showing a good number at $4 billion in the trailing 12 months, and then call it $4.2 billion in a full year 2023. So I would use like $4 billion in their valuation. For a company like Schlumberger, I would take $4 billion, I can multiply it times 10 or 15 to kind of do a back of a napkin evaluation and see if it's worth my time. And yeah, I guess, well, I think it's fairly priced. It's priced at 58.6. And if I looked at free cash flow at 4 billion, multiplied it times 15, I'd get to 60, right? So it's fairly priced. I don't agree with the analysts being this optimistic. They base this mostly on earnings per share, and earnings per share is something I'm going to look at, but the primary valuation I use is free cash flows, because look at the most valuable companies on the stock market, look at their cash flows. That's what makes them the most valuable companies. But earnings per share is interesting. I use it as an input, like some investors don't, but I do, because sometimes you don't see the complete picture unless you see it. And they are going to have a good earnings per share number of $3.53. They're going to grow earnings per share. So that's a very optimistic look. And if you evaluate based on earnings per share, you do get a valuation that's above their current stock price, substantially above their current stock price. So this is an interesting situation because, oil prices, I just showed you oil prices. It's not looking good. So I could see that oil companies begin to slow down their operations and say, Schlumberger, we don't want to do as much in the current quarter or maybe Q4 of 2024 because we have enough oil and the darn oil prices are not very high. So we want to kind of slow down so we can not spend too much money. So I could see that happening. Having said that, Schlumberger would be a pass for me. It's just not showing me enough value. In the energy complex, I have to go in receiving a substantial discount because the oil complex will go up and down, and the acquisition cost of the stock is going to be really important. Let's take a look at the 5-year. So you can see that there's, this was the COVID year when oil price was really down. Now, this is a nice chart of it going up and to the right. Really nice 200% return. You've seen a lot of volatility. But that 200% return and see the 1 year, that's really bad. And that's what happens in this business is you have to get in at the right price levels. There's probably the stock price most definitely was too high, right? We just saw that it really came down. But I'm just not seeing enough value there where I'm getting it at a big discount. Halliburton is a competitor to Schlumberger. And I'm going to look at that company because I've looked at that company closely and I liked what I saw when I saw it last. And Halliburton's in the yellow, Schlumberger's in the blue. And you see Halliburton's kind of outperformed Schlumberger. It's smaller. I think it's more profitable. It generates more free cash. And it's done quite a bit better. If we look at the 1 year, it's right there with Schlumberger because of oil prices. But it continues to outperform it. In the 1 year, it's only down 27%, where Schlumberger is down 31%. So those are the graphs. Now let's take a look at Halliburton and look at the fundamentals. And I should have my spreadsheet ready to show that to you. So Halliburton, similar to Schlumberger, but a little different. Schlumberger is like the biggest in that type of company, oil field services. Halliburton is in the business, but it's not quite as big. And Halliburton is kind of trying to make themselves the experts behind fracking. And if a lot of the reserves in the U.S. are in areas where the oil is somewhat trapped in sand and trapped in the soil. So fracking, and I'm going to try to simplify this, is they use high pressure water and they extract the oil by squeezing it out, almost like squeezing a lemon to get lemon juice. And at high oil prices, it's very profitable. At low oil prices, it's not very profitable. So fracking is somewhat, it follows oil prices. And Halliburton has a lot of expertise when it comes to fracking. And fracking is short for fracturing. They take the oil, they take, I guess, the soils that have the oil and they fracture it. They somewhat, through pressure, break it up and then force the oil to come to the surface. So Halliburton compared to Schlumberger, I'd show you the chart, but they are growing as well. If we look at the quarterly, they continue to grow, although not very well, right? Just a tiny bit. And I would venture to guess that both Halliburton and Schlumberger are going to have a demand problem. With low oil prices, I can only expect that the demand for their services is going to go down. Now, when I finish analyzing this, I'll make one other observation, but not for now. So here's the revenue grew a little bit. Are they profitable? So they are profitable. Okay, good. And Halliburton provides good free cash flow. If my memory serves me right, they have nice cash flow. So here's free cash, 734 million. It's been a little bit of up and down, similar to Schlumberger. But if I take 734 million, multiply times 10, I get 7 billion. Their market cap is 26 billion. So you can see that it's not quite valuing up to that level. If you have, am I looking at the right data? Give me a second here. So free cash flow. Yeah, I knew I was looking at the wrong data. I was looking at the quarterly, and that was incorrect. The free cash flow for the full year is $2,367 million. Multiply that times 10 or 15. Let's go with 10. It would give us a valuation of, let's call it 24 billion. If we went 15, it would give us a valuation of 36 billion. And they're right there. They're fairly priced if you use a conservative valuation, and they're priced at a discount if you see in a type of favorable environment. When I value Halliburton, I believe I have Halliburton valued. Nope, I don't. But when I valued it, I showed like a 20% discount. And that's just not enough of a discount. It is a good time to be thinking of buying these companies, because as we see their prices go down like this, right? Oil isn't going to be down forever. And if they keep going down, they're going to get to a point where they're just, the discounts are really, really attractive. So it'd be a good idea to think of these companies, watch the stock prices. The stock prices continue to go down. Great. If you see oil prices begin to rally, that would cause these to rally as well. It could be a nice, 12 to 24 month investment. Get in, get out, make money. All is good. So for the viewer who wanted to see Halliburton and Schlumberger, there you have it, sir. Thanks for asking about that. All right, so let's get ready for the stonks contest later today, and it's going to be on Broadcom. So Broadcom has been doing fantastic. You look at their stock, it's just really rocking, up 428% in the last 5 years. Part of it is they're really benefiting from the whole, hype around AI, which is really putting a lot of interest into the data center. And the data center most definitely is an area of interest. Okay, great. But I've been an investor in Broadcom for many years. Most recently, I sold a pretty big position, an $80,000 position in Broadcom in late 2023, because I've known of this company. I've been an investor, and we got to late 2023. I'm sitting on a really good gain. I'm like, this AI hype, I think AI is going to happen. It's going to be something. It's going to be something substantial. It's just going to take a long time. It seems like people think it's going to be here next week. It's going to be here by Christmas. No, it's not. It's going to take a while. So the build out of data centers, and I'm going to show you the revenues in a bit, has not matched. Like if you look at the stock appreciation, you'd think, wow, we're growing the revenues by like 40%, 50%. That's not the case. So I got out, made a substantial gain, and then watched from the sidelines, watched it really just get crazy. So I started shorting the stock. So I went from being a stockholder to short seller. And right now I'm in the green on my short position. I'll show that to you in a minute, maybe in a few minutes after we do the analysis on the fundamentals. So Broadcom's a really interesting stock. What's it going to do after the market closes? I think I'll have a better sense around 3 p.m. Eastern, because right now, I mean, a lot of things can happen today. The stock market can rally. A lot of things can happen. So I like guessing with an hour before the close. I kind of have a better sense of where the market's at and how a stock is going to behave. So you're seeing that this stock has really rallied. The 1 year, it's up 73%. Let's take a look at revenue. So revenue is growing, but I want to point something out that this on the surface looks like really good growth, but they acquired a company. So they acquired VMware, which is a software that enables you to take a server and basically, share it across different workloads. It's almost like you take one server and it acts as 5 servers, 10 servers. And that enables companies to really save a lot of money if they use VMware. Very good. So when you grow through acquisition, it's not organic growth. I don't give a company the same amount of credit as if, hey, they grew organically. They got more customers buying the same product. The product's so good that more customers wanted to buy it. And they were able to raise their price because the product's so good, the customers are willing to pay more for it. That's organic. Growth through acquisition could be a very good thing, but it's not the same. Nowhere near. And a lot of businesses get themselves in trouble by trying to grow through acquisition, and they acquire companies that don't fit the specialization and expertise that they have. Then they become like AT&T was in a world of hurt. They acquired DirecTV. They acquired a bunch of stuff they shouldn't have owned. And then they sold it off and lost a lot of money and ended up with a bunch of debt on their balance sheet. That was acquisitions done wrong. And Broadcom, I think the VMware acquisition gives them a greater presence in the data center because VMware is principally a data center software. So that's good. That's good. But again, I know Broadcom really well. I've been an investor in them in and out for a long time. When we look at the quarterly, the number looks really good again. VMware is here. Yes, they grew because they acquired a business. And when you look at their balance sheet, this is where you see the acquisition. You look at total debt, $74 billion. Here it was not too long ago. Okay. It was at $39 billion. They acquired VMware. Now it's $35 billion higher. Okay. So that's a lot of debt. They have debt to EBITDA above. That was 74 billion. And EBITDA is 21 billion. So it'd take them roughly 3.5, 4 years to pay off debt if they focus their EBITDA on paying off debt. So you can see they have a riskier balance sheet right now because they took on so much debt to acquire VMware. That is a negative aspect of Broadcom is, okay, you have more debt. And how quickly are you going to pay it off? The awesome companies that are at your valuation, by the way, they don't carry much debt. Their valuation is very high, $717 billion. You look at companies in their peer group, they don't carry that kind of debt. So that's a big issue that I see with Broadcom is their balance sheet. Now, their balance sheet's not super risky. I'm just pointing out, if you look at the best companies, like Apple has a beautiful balance sheet. So does Microsoft and all the top companies. You look at their balance sheet and you're like, geez, man, those guys have so much money. Where Broadcom acquired by borrowing money, which is a sign that they're not quite in that peer group. Apple has so much cash, they could acquire a big giant business like VMware. They didn't have to take out a loan. They paid cash. Meta can acquire a big giant business, cash. And I can go on and show you other companies. So that's one opinion that I have on Broadcom. Their cash flow is good. When you look at cash flow, Broadcom's always been a good cash flow company. And you can see that their cash flow, see how they have a nice upward trajectory. That is very nice. That's why I bought Broadcom. That's why I like Broadcom. That's why I made money on Broadcom. Cash flow. Okay, so analysts, they like the stock. I mean, the stock's really run up, but it's only an 18.9% discount. And that's after the stock has had a pullback recently, right? So if you look at from the high to where it's at now, it's down 17%. And when you look at from the high to the low point we achieved on August 7th, it was down 25%. So you can see a lot of volatility. The market may be irrational at times, but it kind of gathers itself and it realizes, whoa, is this company overpriced? I happen to think this company is overpriced, which is why I shorted it. Let's go take a look at my valuation of Broadcom and see where this stock is valued at, in my opinion. So here's the cash flows we were seeing earlier. There's my projection. And I use a 9% discount rate. You saw earlier in this stream that I used a lower, and actually haven't gone this far. But if I was looking at like Meta or Apple, or I can go 7.5, I can go 8. But since Broadcom has that balance sheet with higher risk, I go with 9. That's where the interest rates that I was talking about earlier, this is where they show up. If I were to, just from an example, let's say I changed it to 15, it changes the valuation by a big amount because you're discounting. And if you understand what discounting means within a finance, narrative, you understand the power of a discount rate. I get the net present value of all these cash flows using that discount rate. I grow cash flows by 10% and then long-term by 4%, very reasonable. And I get to an intrinsic value of the company of 439 billion. Add cash and take away debt. This is why I take away debt. These guys carry a lot of debt. So I don't want to value cash flows really high, but they have a lot of cash, a lot of debt. I decrement that because I think it's a decrement to value of an enterprise. So their equity value, in my opinion, is 375 billion. I think I need to update my numbers because I think their market cap's a little different. So let's update that on the fly. All right, so they have a market cap of 714. Oh, it's not too far off. And then shares outstanding are correct. And what is the share price? 152.99. So I believe that Broadcom, if you look at cash flows and decrement debt, it's being sold at a premium of 47%, which is a pretty tall premium on Broadcom. Their earnings per share, and like Charlie Munger never used earnings per share. He actually badmouthed earnings per share. He'd be very cautious about earnings per share. I still use it just to know, what's the market probably looking at this stock based on. And if I do my valuation on earnings per share and I use a P of 25, these guys are not a high growth company. They're a growing enterprise, but they did it through acquisition. So I don't give them the same amount of credit as Meta. Meta grew at the same rate, but they did it organically. That's way better. So a 25 is very generous as a PE. I could easily say 18 and it really changes it. In fact, I'm gonna go with 18. I'm gonna say you're gonna grow those earnings per share. That's fine. But overall, I think it's a stock that's priced at a premium. Now, the NVDA earnings, NVIDIA did show growth. They showed a lot of things that were very impressive, but not impressive enough. When you have a stock price as high as NVIDIA, or in the case of Broadcom is going to have to show up tonight with a real impressive earnings. And if they don't, the stock price can crash 10%. What do I think is going to happen? I think the stock's going to go down. So I'm guessing down on the contest. The percentage, I got a noodle with that. I've got 10 or 15 guesses. And I got to go to the Stonks website and redeem my daily reward. And I think I'm going to use up maybe 10 of them because I'm going to go after this one. Now let's look at my short position on this stock. So I am shorting Broadcom. And I've got basically, call it $5,000 at risk. And I'm up 3% on my short position. I started shorting this stock roughly about 2 months ago. And so far that, the story hasn't changed. I'm shorting stocks, not because I'm a short seller, but because I'm an investor and I'm a student of the game. And there's certain things that are kind of obvious. The AI hype, to me, is an obvious misalignment of timelines. AI will be something in 10 years, but investors, they don't wait 10 years. They'll wait 10 days. They'll wait maybe 10 months and they become impatient. Then you start seeing things really unravel. So I thought, hey, you know what? Let me put some capital out there because I have been putting videos out on Broadcom, sharing this narrative that I just shared with you. And I don't want to do analysis and not have the opportunity to make money. So that's why I'm putting capital out there to make some money. The better I get at short selling, I think the bigger I'm going to put, capital out there. I don't want to lose my shirt. I've got over $200,000 invested in Meta. I love that investment. Great. Got a pretty sizable amount in Alphabet. So I'm willing to put capital out there, but it has to be, kind of a proven method. I like keeping things simple, having a good process, and being able to get better over time. All right. So I'm not seeing a lot of chat messages. Everybody just chat in there, say hi, do whatever you'd like to do there. It'd be nice to just know that chat is working. I saw one message from Trader Prad, but I saw that one maybe a half hour ago. So let me know if you guys are still out there. Let me see if I want to pop out chat. Sometimes that gives me a refresh. Yep. Okay. So stock market should be open. Let's see what's going on with the stock market. And the market is in the green. NASDAQ up 0.51. S&P up slightly. Dow Jones, 30 companies, very well-known companies, down a little bit. We're 13 minutes into trading. So it's good to see that, hey, it's trying to go up. It's trying to go up. It's been going down, but it's trying. A for effort. This is what it's done over the last 5 days. So we need it to go up. We'd like it to go up. It's all right if it goes down. We'll buy more shares in the companies that we like. All right, so we went over Broadcom. Another company that's going to announce after the market closes is DocuSign. And I like DocuSign. I think what they do very well, and it's pretty much integrated into so many types of transactions. And it's the most recognized, well-known signature capture technology out there. It'd be nice to see them diversify. This stock really did well during the pandemic days when, okay, nobody can meet in person, so we're going to have everybody DocuSign things. But since then, the market just completely sold them off and said, oh, you're only worth 13% of what you used to be worth, which is kind of crazy. At times, the market's very irrational. Now, I invested in this stock, and man, it looked really good when this happened, which was they were an acquisition target, and the stock looked great. I still own DocuSign, and I'll show you where I'm at with it. But since that event, the stock has kind of just gone sideways and not done much. I continue to think this is a very good acquisition target. I'm going to show you their financials. Their financials are really good. This is like, call them like one area of products, like they do one thing, but they do it very well. And they keep growing. This is all organic growth. They didn't grow these amounts by acquiring somebody. No, they grew that amount by being the number one player in this space. They're almost a $3 billion company. And so that's good. They're profitable. Balance sheet's great. I'm going to show you the $1 billion of cash and $138 million of debt. They can scratch a check, pay off their debt, be good to go. Cash flow. Free cash flow, $904 million. This is a growing business. If I multiplied it times 20, quality balance sheet, profitable. They get to like 18 billion in valuation, but they're at 11 billion. So looking closely at the valuation I have for DocuSign, so I'm going to make this little small, update my numbers, and then we'll. Okay, so 57.10, and their market cap is 11,620. Shares outstanding 204. 69. So 69. Okay, and all right, so This stock is discounted by 50% overall, and they keep buying back shares. They have cash to buy back shares, so they've been doing so, which is a good idea. I continue to think these guys are a good acquisition target. It really proved itself to be the case in late 23 when you saw a private equity group look at buying DocuSign and taking it private and paying investors a nice premium. So overall, I think this is just a good stock to hold. I haven't been doing all that great with this stock. Software stocks have been left behind because everybody's crazy about this AI hype. Oh, it's the money's in the data center. I'm up 11% on the stock, which isn't a great return. I've owned the stock for, call it a year and a half, 2 years. So that's not a great return. I still think it's discounted. So I keep buying shares. I own $22,410 of the stock. And I keep buying because I think software is going to begin to work. Software is a very good industry. I like showing you sectors just so that we get smart around, sectors are a way of saying, look, we all know cars, right? Or we probably can get our heads around cars. And you know that, hey, a Mercedes, let's say you got a year-old Mercedes, a nice S-Class, and you see it, be put on, let's say, Carvana. And then you have a Kia. Kia is a great car, by the way. I like Kia. They're headquartered not too far from where I live. But that car has a different level of value, right? And you saw that the Mercedes, which, the S-Class is like $120,000 car, but you see it priced for 30 grand. And you're like, wow, man, that's premium cars like that car sell much higher. And they've been selling that way for the last 20 years. The Kia, on the other hand, is an affordable car. If you saw that for 20 grand, you'd be like, whatever. And when you look at industries and sectors like financials and all these sectors, you see a particular rate of return over the 5-year. Like financials is okay. Healthcare is really good. Technology is awesome. And then we're going to drill into technology. Oh, no, didn't give it to me the way I wanted it. Let's go back to... This is what I wanted. And I'm going to show you where the software industry, because you have a sector is like a collection of industries, and then you focus in, and an industry is one part of a sector. And when we look at software over its history, it's just a really good industry. So here's software applications, and it's a good industry. Software infrastructure, good industries. Semiconductors have been kind of stealing all the money. But this has been a winning recipe for me for 20 years. So that's why I'm like optimistic. It's been left behind due to the AI hype, the data center build out. And I have a nice collection of software companies. They're going to work. They make too much money. Microsoft's a software company. I don't need to convince anybody that that's a really valuable business. And there's a lot of valuable software companies, but outside of Microsoft, just about every software company has been discounted and left behind. And we'll see when they recover and what the recovery looks like for software companies. So that is DocuSign. All right. So let's look at the market again, see where we're at. All right. NASDAQ is still in the green. That looks good. S&P. All right, cool. So let's take a peek at our friends over at NVIDIA. NVIDIA's up. All right. Trying to pick itself up off the mat. The valuation of NVIDIA, they've lost over $300 billion of market cap this week. Oh, man, that's so much market cap. But it'll be interesting to follow this one and see where it goes. So, all right, everyone. So I appreciate you guys joining. Looks like we've got a crew of 15. Thank you very much for joining. If there's no other questions, I will land the plane here. Wish you guys a phenomenal day. I hope all your trades go really well. And good luck on the contest later on today. Hopefully the market keeps going into the green and really rallies up. So everybody, thanks for tuning in. Join me again tomorrow. For all we know, tomorrow is going to have a lot of fireworks. Again, the unemployment report is going to drive the market. If it comes in as expected, probably nothing. But if it comes in and surprises to the optimistic side or the pessimistic side, to the positive or to the negative, the market's going to move big, and it'll be interesting to see it. So everybody, thanks for tuning in, and have a good day.